money. First, we have to show you this. So, we're going to be talking about money. So monopolize money, okay, obviously, hedge fund without any money doesn't make any sense. We have to raise a lot of capital into our hedge fund products. Important to note, our hedge fund products are only for accredited investors. And also, I'm going to show you some back tests. And a lot of the back tests are talking about historical performance, or they're just simulations. So take note of that. And I think all of you already know this is just a data science conference, not an investor conference. But there we go. OK, so let's give you an update on money. How are we doing? Well, Numerai One is our first institutional high-sharp product. It is the one you've seen on our website, numerai.fund. And what's happened with that fund is over the last about 14 months or so, it's gone from just $7 million, which is kind of like my money and some friends' money, to $70 million, because we closed our first anchor institutional investor, Canadian pension fund. So this is a very good last few months for raising assets in the fund. And it's also been an interesting time in the market to do this, which we'll get to. But what's also important is that while raising this money, a lot of investors are interested in something called capacity rights. So what does that mean? Well, it means you get to invest more later without renegotiating fees. And so during the time we've raised this $70 million, we've also added $200 million in capacity that's taken up in this fund. We're going to cap this fund at $500 million. So like I said, we already have $70 million in this fund trading right now. And we already have $200 million in capacity rights that have been spoken for. So, and the performance has been good. So I don't see any reason not to put a limit on this fund and cap it at $500 million. So that's the plan, to try to get to this by the end of the year. But you might say, well, if you're trying to monopolize money, why would you close the fund? And the reason is there are other parts of the investment universe that are quite interesting to us. So this is what sort of a hedge fund industry looks like. Quant equity market neutral is a tiny subset of quant hedge funds, which is itself a tiny subset of hedge funds, which is itself a tiny subset of all of the money in the world. So in order for Numerai to have all the money in the world, and manage all the money in the world, we are going to need to make products in these other categories. It would not make sense for the entire world's capital to be invested in one market-neutral hedge fund. So we're about to get to my favorite part. I'm excited to announce our second product, which is called Numerai Supreme. What is it? Numerai Supreme is an unconstrained, high-return expression of the Numerai meta model. So what does that mean? Well, here are the risk characteristics of Numerai One, our institutional market-neutral product. As you can see, they're very conservative. We never have more than 2% in one position. If anything drifts above that, we trade it down to be below 2%. So that's very safe. We're also country neutral, sector neutral, and we have a beta of 0, and very, very limited exposure to style factors. All of this put into the optimizer makes our volatility about 10% in this fund. That means annualized volatility is 10%. If you're not familiar with volatility, that sort of means it's quite hard for the fund to go down much more than 10% in a single year because the risks are constrained. What does all this do in the optimizer when you give it these constraints? Well, if you take the meta model signal, what the meta model signal is the Numerai community, all of their models put together, their expected return, right? So you could kind of make this plot and say, well, there's some things that are really likely to go up according to the meta model, and there are other things that are really likely to go down. So maybe you want to short those ones. And so what the optimizer does is it tries to satisfy all those constraints by, first, it might want to buy something that's right at the top, that's got very high expected return, and then short something that's right at the bottom. But it starts to run out of ideas because of all the constraints. So suddenly it has to do something like buy a stock that it actually believes has an expected return of 0. So why would you buy something with expected return of 0? Well, it helps to balance risks. It helps to satisfy these optimizer constraints. So it's a bit like Numerai One is kind of like caring a lot about the risk constraints and not caring as much about what the meta model really thinks. So we can make some liberal edits to these risk constraints and really relax them. So maybe we have a fund that doesn't have this 2% position size limit. Maybe we can go to 3% or 4% in a single position. After all, if the meta model really wants that position, why wouldn't we trust the data science community and the kind of largest one ever established to solve this problem? Seems like you maybe want to trust it. We can delete the country and sector neutral requirements. Let's keep it beta neutral. Any idiot can buy the market. So let's keep it beta neutral and keep the market exposure 0. And all of this kind of makes a product that has more like 20% annualized volatility, which is still very low. For example, Bitcoin is something like 80% annualized volatility. So it's still quite low vol, but it's got no constraints. So what do these optimizer settings allow for? And this is what it looks like. This is what Numerai Supreme looks like. It buys only the stuff at the top, only the stuff with the highest expected returns, because it doesn't have to make all these constant risk trade-offs that it doesn't really want to make. And it gets to short the worst companies in the world in order to fund its investment in the longs. So it's neutral. It's for believers only, high risk. There's a higher lockup on it, and it's higher fee. And it's much more limited in capacity, because some of the stocks that it really likes to buy are a little bit lower liquidity than the other stocks that Numerai One buys. In other words, this fund is Numerai's medallion fund. And here is what it looks like. Would you want to bet against this? This is actually an AI-generated image from Midjourney, but I really like it. I think it was, the prompt was, super powerful alien walking down Wall Street, or something like that. It's also purple, got purple gas, because I said wearing a gas mask. And the purple is also representative of true contribution, which I don't believe we could have done Numerai Supreme without true contribution. I'm excited to say that Numerai Supreme will start trading on June 30th. So we're about to have, in a few minutes, I'm going to speak with Jonathan Larkin, the managing director of Columbia Endowment, and the former Global Head of Equities at Millennium, and the former CIO of Quantopian. So super knowledgeable guy to talk to about this stuff. And also Joey Krug, the Co-CIO of Pantera. And we're going to talk about everything to do with Numerai. So whenever you guys are ready, I'll be here. Okay, welcome.
All right.
Take your seats. So, Jonathan, we've been speaking a lot over the last few years. I think when I first heard about you, you were the CIO at Quantopian, and you used to write interesting things about that. And then we also met to talk about Numerai. But one of the things I am interested in is Millennium, right? Millennium has made this amazing return stream by basically having lots of managers independently managing portfolios and putting them together. And that sounds kind of like Numerai. So I wanted to hear your thoughts on like what Millennium got right, what Quantopian could learn from it, and maybe what Numerai's learned.
Yeah, fantastic. So Richard, first of all, thank you very much for having me here today to chat. I do have to start off and just say that I'm sort of representing myself personally today, not my employer. But with that out of the way, as Richard mentioned, for the bulk of my early career, I was sort of in traditional finance in this kind of multi-manager style hedge fund, which is a style that I love and has been very, very successful for a handful of firms. And as Richard mentioned, that style involves hiring independent trading teams, very tightly constraining their risk profile and scaling that up across a large organization. And a large organization might be something like 100 to 200 teams. So that model has been quite successful, but in a traditional hiring or contractual relationship, there's a natural ceiling to how much that can really scale. There's also it's very, very difficult and sometimes intentionally prohibited to collaborate across teams because you want to make sure that the correlation among the teams is quite low so that the portfolio effect is strong. So when I first came across Quantopian, I saw what I felt was a natural evolution of that business model. The first being sort of that the scale is potentially uncapped because you're not directly hiring somebody in an employment relationship. And the other thing was, I felt that it removed a lot of the frictions that exist in traditional finance and traditional employment relationships. So if you have in traditional sense, you have a team over here who's producing and you want to hire them, it takes a lot of time and effort to hire them. They have to leave what they've done, move over to your organization, start everything new. There's a lot of risk to sort of, that they get something wrong or, the alpha kind of decays over the time that, they're doing that. So another innovation which I was excited about from Quantopian is the fact that there was this very, very good research platform where users would come and kind of, create strategies on the platform, and then we could move those to production with very low risk, very low transfer risk, I should say. And I think Numerai has actually taken things a bit farther in the sense that you've kind of solved the key problem in all of these organizations, which is coordination, right? And true contribution is kind of the latest evolution of that. So it's not just kind of reaching out to this massive global crowd of data scientists. It's a way to kind of marshal all of that intelligence in a very, very effective way.
Yeah, I think that's definitely what we hope to achieve with it. Like one thing we always want is that if someone's behaving selfishly to respond to incentives, that produces the right outcome, right? So if you're just trying to make a good back test or something, that might not help us at all. But if you only get paid on true contribution, or you get a large part of your payments come in true contribution, then it can have a big effect. So yeah, I mean, it seems like Millennium's been like this huge success story, but it's somehow not very like automated. Like it's not like the teams on Millennium are data scientists around the world sitting on their own laptops, right? They actually bring all of them are their own independent funds. Is that right?
I mean, it's these models, they're all pretty complex, so it's hard to fully generalize. But yeah, I mean, everybody exists in either like an employment relationship or some sort of contractual relationship which is negotiated.
Right. So Joey, I also wanted to mention, interesting story with Joey. Pantera recently invested in NMR, and I remember putting Joey in touch with CrowdSense, and then a few days later, basically seeing a huge stake on Numerai. So maybe you can describe what that was like.
Sure. So I remember I told Richard like years ago, I always said Pantera will buy a sizable NMR position, once the model has been proved out. And so we concluded that we thought it had been proved out and that it was working. And so we built a position. And then with CrowdSent, at Pantera, we like to stake any asset we can so we can earn a higher yield on it. Obviously, with Numerai, it's a bit different because you actually have to do something besides just running a piece of software to actually earn something. And so Richard introduced us to CrowdSend, and we ended up putting a lot of our stake with them. But I think more people should do things like that because we would love to diversify our position across multiple people competing in the tournament.
Yeah, I think it's amazing. I mean, to me, I was just watching the community presentations earlier, and it's like all this stuff's been built on top of Numerai that I didn't even know about. And the fact that CrowdSent has built a company on top of Numerai and talked you into investing in them, and it's kind of amazing for what it says about the future. I mean, I could see that in a few years there could be like hundreds of little funds that are focused on making true contribution instead of trading themselves in the market, which is very inefficient. Yeah, going back to we talked this talk I just gave was on money, right? So like, does it surprise you that Numerai has so little assets under management at the moment? To me, it's taken quite a long time to get to 70 million, but maybe you can explain some of the dynamics of that.
Sure, it's absolutely not surprising to me at all. In fact, quite honestly, it's a bit the other way around. The fact that you've gotten to 70 million is an accomplishment that you and everybody in this room should be very proud about. But yeah, so wearing my kind of institutional investor hat, institutional investors are fiduciaries. They need to really understand a business, over different market cycles, and it takes a long, long time to really get that level of understanding and get that level of comfort. Also, specifically with equity market neutral. Equity market neutral is kind of the gold standard of alpha generation, but it's still a bit of a niche-y type of market. Some investors don't even touch the space because it's so esoteric. And then you have Numerai, which is a quant fund with machine learning, with crypto economics that's crowdsourced. It's sort of like 4 degrees more complex to understand. So I think it'll take time for that, and I again commend you with where you've gotten to today, and I think it's only a matter of time before other institutions catch on. I've
actually written about when we first talked about our fund performance. Market neutral is like hard mode for hedge funds. And I guess that's because of all the neutralizers. So why do you say that it's like the gold standard for alpha generation for people who maybe aren't familiar with how market neutral works?
Right. So if you're an investor, you can get exposure to the market. The equity market, kind of over very, very long periods of time tends to trend up. So people typically like to have exposure to that return stream. That return stream is quite volatile though, and it's virtually costless to obtain access to that. But what is super valuable and should be very costly is getting access to a return stream that's completely uncorrelated with the market, completely uncorrelated with your own portfolio, and has the promise of hopefully generating returns independent of anything and consistently every month. So that's super valuable. And when somebody quotes a return like 10% a year or so, it might not seem particularly exciting, especially when the equity market has done what it's done over the past decade or so. But what's exciting is the fact that there's a promise that 10% comes irregardless of what's happening in the economy or what's happening with the broader market.
Joey, I was actually going to ask you more about what you've seen in DeFi and other things in cryptocurrency. I mean, you've overseen Pantera from what assets to what assets, and what have all the dynamics been?
Yeah, I think when I joined Pantera, we had roughly 150 million under management, and today we have, as of this morning, like 5.9 billion.
Wow.
So we've sort of been, blitzscaling the entire time. It was 10 of us in a room in Menlo Park back then. Now we have 65 people. So it's been crazy. I remember the, peak of the market in 2017 was really interesting because, we knew DeFi was going to be a big thing, but there was actually only like one main DeFi project, which was MakerDAO at the time, and they had just launched kind of right at the peak. And there was a lot of early stage stuff that you could invest in, but there wasn't a whole lot in the market, and stuff that was live didn't have revenues or high usage or any of this stuff, right? Uniswap wasn't even a thing.
Yeah.
And if you fast forward a bit, it's just grown crazy. DEXs do something on the order of 60 to 100 billion in volume a month, depending on the month. The amount of value locked in DeFi is how big is this parallel financial system? Went from peak of 2017, under $1 billion to now on the order of $100 billion. Still a long way to go, right? Traditional finance has many, many trillions. But I think it's the future of finance, and Numerai is part of that, right? Numerai is that for disrupting the hedge fund industry. But if you look in DeFi, there's also things that disrupt lending, disrupt exchanges, anything you can think of, derivatives. It's really expansive, and it's kind of the same. Everything in DeFi kind of has the same shared values, right? It's open source, fairly transparent, disintermediation, removing some middlemen. Yeah, that's kind of my thoughts on it.
How do you think about valuing these types of assets? I mean, that's always been this head scratcher for people in finance, where it's there's no net present value of Bitcoin, but there is a net present value of a bubblegum company or something like that. And so even with Numerai, how do you think about making investment decisions in a space that's so different?
Yeah, I mean, I think there's a couple ways you can think about it, right? One way is to say, well, the classic kind of Silicon Valley bet is if something gets users, you'll figure out a way to monetize them somehow. So that's one way to think about it. Another way to think about it is a lot of DeFi protocols actually have revenue, and some of them distribute that revenue to token holders. Some of them use it to fund growth. There's a lot of different approaches out there, but everything has some sort of key, KPI, key metric, whether it's volume or how much is being lent out or borrowed on a lending protocol. If you look at Numerai, I mean, there's a few key metrics, right? One is what's the AUM of the hedge fund? So that's a proxy for demand for Numerai as a hedge fund. There's also what does the Sharpe ratio look like? I was scrolling through the True Contribution blog post earlier and noticed that the Sharpe ratio is kind of going up like this over time, and hopefully that keeps happening, which would be a very good thing for us as NMR holders. And so you don't have to have an exact economic model figured out for how say an investor like us makes money. Although if you look at NMR, right now we're giving it to CrowdSent, right? And they're submitting predictions or whatever, and the idea is that hopefully over time we can distribute that to more and more different people to get a pretty diversified exposure to what stakers are doing, and they basically get leverage essentially, right? They get to stake more on their models.
Maybe final question for Jonathan. What do you think we're doing wrong? You seem to be a fan. What do you think we could do better at? Maybe when it comes to monopolize money.
That's a good question. I am a big fan of the core competition. I'm not completely sold yet on the signals competition. Mainly because one of the main benefits I see of your original competition is that you sort of give the data in a way that sort of protects people from shooting themselves in the foot, right? So there's a lot of things in terms of manipulating raw data in finance for quantitative trading, which are not particularly obvious, even to extremely successful data scientists in other domains. The most sort of common one is that you have to work cross-sectionally as opposed to working at the individual security level. And the fact that you sort of obfuscate the ticker and you give these anonymous features doesn't really let somebody work at the particular investment ID level. And then with respect to the data as well, in signals, it is quite interesting, the value proposition to bring your own unique data source, but it's also a lot of things can go wrong with that as well in terms of survivorship bias or look-ahead bias or the data not being point in time, like all of these things that you Numerai take care of with your data set and a proper quantitative trading organization, or what Quantopian did on the platform, take care of all of that data and present it in a way which is super clean and aligned across stickers. That's another thing. The symbology is a huge issue. So with signals, you're kind of like pushing that burden onto the user. So I think in my mind the jury's still out on that.
Yeah, I appreciate the rebuke of signals. No, I mean, it's funny, like Numerai's pitch was like, like data scientists don't have access to financial data. So we've created Numerai to give them access to high quality, tabular, clean data. And signals is a bit like, well, you kind of need your own data. And I've been kind of amazed at the growth. Like one thing we didn't talk about today was the growth in signals. Like signals is now at over $4 million staked, which is bigger than Numerai was maybe 18 months ago. And it also has there's been 10 times more signals on signals as well. And one of the things I'm amazed by, because the jury's still out, and in fact we don't use signals in the meta model yet. We're still thinking about it. But one of the interesting things is how volatile some of the signals models can be, versus say any model built on Numerai's data is going to be kind of peaceful because it's like using our data. But the models that they make, because we do so much feature neutralization to the signals that you would think there wouldn't be much place to move. But some of them have insane daily volatility, and I don't really know how they're doing that. But to me, it's key, because for the whole strategy is of a type 4 hedge fund. It's like if someone out there does have an incredible signal, that's in their own form, right? It's they have the tickers of the symbol, of the signal. We want to get that too. And so even if it's just a handful of signals that end up being very valuable and having TC, then it's worthwhile. In fact, we're about to backfill signals with true contribution as well. And I have no idea how that's going to look. I mean, it's possible that some people on signals have much higher, maybe an order of magnitude higher true contribution because they're using a completely orthogonal data set. Right. Well, I think we should cut it here. I hope you guys get a chance to meet with these guys. I've known them both for probably 5 years or so each. I met Joey when he was 21, I think. So yeah, hope you find time to talk to each other. Thanks a lot.
Thanks, Richard.
Great to see the community being so supportive of so many things that's being done.
Yeah, so I wanted to maybe get started with, so I've introduced you as, you're one of the early people at Renaissance. You co-founded it with Jim Simons back in 1982, was it?
Right.
And you've also, I'm sure a lot of the audience here has read the book, The Man Who Solved the Market. Howard was one of the key sources in that book. And so maybe you can explain kind of your early history with quant investing and what it was like back then.
Sure. I don't go back to Louis Bachelier, his 1900 thesis on speculation, who really sort of started with stochastic processes. I did read the 1967 book by Ed Thorpe, Beat the Market, which really was straight arbitrage on warrants and stuff at that time. And Jim Simons, who was also at MIT with Thorpe, read that book as well. But back in the late 70s, I was doing some work at the Rand Corporation while I was still a professor at Penn, and was introduced to Jim by a mutual friend, and we hit it off. We invested together in one or two venture things, and then I went out and looked at some of the database things he was doing. At the time, I was the editor of the ACM Transactions on Database Journal, and they were trying to build databases for doing some of the quant trading. It was still pretty early. It was Jim and Lenny Baum, as described in that book. But in the middle of '82, Jim said, "Why don't you take a leave of absence and we'll start a company and do this whole thing seriously." And so in April of '82, we created Renaissance Technologies with Jim as CEO and me as president, and two other employees, Jim's assistant and Mark Silber, who became the chief administrative officer until about 6 months ago, a couple of months ago, really. And I think what Renaissance understood early on that a lot of people didn't was that it was all about data. It was all about getting huge amounts of data. And even today, Renaissance uses tick data collected back in the 70s when nobody thought you could do it, when it was super expensive to store, so that we had a lot of compression algorithm stuff going on, so we could compress the data when processors weren't nearly as fast. But in those first few years, there were a lot of attempts, and the book does a modestly decent job of describing it, a lot of attempts to get all the quant working at scale. So when we started Renaissance in April '82, we had $70 million, and we could only put $35 million to work in the quant side. So I helped invest the other $35 million in venture. So for 7 years, we also had a venture capital fund. By '89, we had gotten to the ability to put $1 billion to work in the quant side, and had a model structure which we could add and delete signals from every week, or certainly every month. Later on, it became every month, and could continue to backtest on all of the data that we had, which was at the beginning mostly commodity and currency data, because most of a medallion fund, which is sort of the gold standard or the platinum standard, really, of quant funds.
So were you ever in that fund? You were in the medallion fund as an investor?
Oh, absolutely. I was an investor from its predecessor fund, which had a funny name, I think Johannes from Kepler, and then became Medallion, and all the way through. So because the fund was so successful over time, they began to have some of the outside investors get out of the fund. In 2000, I forget the exact year, 3, 4, 5, something in that range, they started they started giving back all your profits every 6 months. And then in 2008-9, they got rid of all the outside investors except for the employees and a few old timers like myself. Because that was the currency with which they pay employees is capacity in that fund.
Right.
And even by 2013 or 14, I was even asked if I would give up my stake in it. And having made a lot of money by that time in that fund, but also in the venture capital stuff that I was doing after that, and starting to see things, I did. But I think the key, in the late 90s, even say 97, 98, or 99, Renaissance had more processors per employee than Google. It was massively parallel computing before the world was doing it, and it was monster database just before the world was doing it. And it was really clever and important modeling of all sorts of features to figure out how to make something that would make a lot of money. And at that point, a lot of the world didn't like quantitative models. A lot of the world felt that there was kind of something wrong about the fact that you didn't have to understand the underlying instrument that you were trading, whether it was a currency or a commodity or a stock or an option. Although Renaissance never did much in trading options. Susquehanna did quite a lot on that side of it. And so raising money was hard at the beginning, but then it began to exponentiate on its own. And there was no need to raise money for quite a long time. And I think to the extent that you cap the Numerai One at 500 million, you can have the same thing, which is let's let the current investors continue to grow their money to the natural capacity of the fund before we add new people to it. Because we can always, if we add the capital, all we're going to do is lower the returns eventually for everyone. So,
exactly. Yeah, a lot of, I think people don't understand that. They get surprised when it's like, it seems like clear that you'd always want more money in a fund. But the capacity is very real, and Renaissance Medallion Fund was like a very good example of that, like where, it just sort of like wouldn't work at all on maybe like 50 billion, but works brilliantly on 10 billion.
Yeah, I mean, basically the capacity was roughly 5 billion for a really long time, and then slowly but surely it crept up a little bit. But I don't know, barely 10 billion. I don't even know if it's that right now. So you just have to do that, otherwise you lose the returns. You can't make the trades. Remember, among the things you model are not just the underlying instruments, but market impact becomes critical. Counterparty risk becomes critical, and a lot of other things about how the markets actually work.
Was there ever a time during this amazing run of this medallion fund where you were scared and wanted to pull your money out, or did it was just so much evidence of it working that it was just easy to trust?
I don't remember exactly when. There was one. I was never scared, but there was one quarter of a negative performance in the entire history, and a few months here and there of negative performance. But it was very minor negative performance. So it was a money machine. Is the only way to describe it. I mean, it just continued to make money. It had to be carefully monitored, but the key was that humans didn't make any decisions except for an overall world risk level decision. When the world was going crazy, you had to be a little more careful. I was with Jim in Japan, in Tokyo, in October of '87 during that crash, and we were down. We didn't have. I think we had 100 million in, and we lost 10 million that day. My wife woke us up at 3 a.m. Saying, "Turn on CNN. There's the markets are going crazy." Then we made 20 million the next day. We made it all back, and then.
How distressing! Yeah.
Yeah, but the point was not to say, "Oh my God, we lost 10 million. Let's stop things and figure it out." The thing is to believe in the model. If it is a model, and it's going to work, and that's why when you talk about drawdowns in Numerai Supreme, they don't scare me that much. I mean, if it were 50%, I might be scared, but at 24%, I'm less scared. That can easily happen along the life of a fund with it. So that volatility is your friend.
Yeah. It's so interesting, though. I mean, yeah, it's when you're running a fund or when you have a lot of employees, how quickly small patches of negative performance can be very demotivating. Same with the Numerai users. Some of our users get to the top of the leaderboard, and they think they must have cracked the whole thing. And then a few months later, they learn about past performance does not equal future results.
The markets make everyone humble, but
it makes everyone humble. Yeah. So maybe talk about Numerai. So when we first met, I think you were probably one of the first investors I ever met, and I didn't even know I was going to meet you. I was going to meet Bill Trenchard, and you were in the room, and I started to explain quantitative investing to you. And you were like, "Oh, I have some familiarity with that."
Yeah.
So what did you kind of like about Numerai at that time? I mean, I think the company would have been 3 months old at that time, and you just somehow luckily met you.
Well, and obviously Bill, one of my partners at First Round, was terrific, and he and I have done a lot of quant investing over the years, and seeding quant funds. I think what impressed me was that you understood risk management, and too many of the people who pitch me at various times on quant funds will just show me a back test and say, look, I'm making 97%, and then they'll say, and by the way, and the two key questions I ask in that case is, how many of the trades that your signals suggested you trade on did you get? And they'll say, what do you mean? Don't I get them all? And the answer is not in the real markets. In the real markets, you get some of them. If you're lucky, if you're fast, you might get 30%, you might get 50%, but you don't get them all. And I tell you, rerun your back test with a random variable that flip a coin and see what happens if you only get 50% of the trades your signals tell you to get. And then they come back with the performance that they would have gotten in real life, which is often negative, or certainly far diminished from where it started. You had a pretty good sense, having been in the real world of trading, of what markets worked like and what risk control was. And I think that impressed me. And then the other part was being, an OR PhD and somebody involved in cryptography, the notion of using homomorphic encryption to do things was very fascinating. It was a completely different take, and we were interested in crowdsourcing at that time, and so that really resonated well with us.
Yeah, I remember that. I actually remember our very first data set. I don't know if maybe no one would remember this. We had, the data set was all in this ciphertext of homomorphic encryption. And it was basically impossible to model. And so we had to come up with other ways to obfuscate it. But the fact that it was obfuscated was very off-putting to most investors. It was like, how are they going to find structure in this data when it's all obfuscated? But I think with your experience of Renaissance and things like, yeah, most of the mathematicians, they aren't looking at the numbers of every company or something like that. They're using models, and so it doesn't matter too much how obfuscated the data is.
Yeah, in fact, one of the keys at Renaissance in the research side is they don't hire people who know the markets. They did, for many years. They hire mathematicians, statisticians, physicists, et cetera, computer scientists, data scientists, and they don't really want them to think about what the number means in a semantic sense, that it's a stock price or a stock volume. Whatever. It's just these are features and numbers which you want to put into your model to crunch to get to a prediction. And that's why I like the obfuscation. Actually, it appealed to me because it had the equivalent of doing that without having to hire people, with those other skills.
Yeah, actually, we have a lot of employees at Numerai who say they never saw themselves as working at a hedge fund. But because everything that Numerai does is so kind of mathematical and data science and machine learning, and I think that's true of our users too. I mean, I don't think a lot of our best data scientists on Numerai are hoping to get a job on Wall Street. They don't want to work on Wall Street. They just want to model data. So it's interesting how it's such a it's so non-domain specific applying models. So yeah, I mean, one thing I've also, because of the risk controls we've had in Numerai One, a lot of friends have actually asked before, can't you do a higher volatility version of Numerai? And one thing I didn't want to do is just say, well, let's take Numerai One and then leverage it more. So it's already leveraged, right? Maybe leverage it more. That's not quite, that does add risk in its own way. But what was interesting when we were doing this research on Numerai Supreme was like, we could make this more like 20% vol product with using the same leverage, but just taking more extreme signals. So is this also something you've seen in the hedge fund space? Like a fund is built on low leverage for kind of a long time, and then as they learn more and feel better about things, they sort of make other higher risk products?
Sure, and they do it typically by expanding the universe of instruments that they trade, so that initially they only want to trade the most super liquid stuff that's out there, because then you don't really have to worry as much about market impact, and usually less about counterparty risk. Although in the crypto world that becomes still a big issue. But then as they add instruments, that's where they're able to scarf up more return, but they have to be a little more careful on those edges. So when you get into the smaller cap stocks, for example, human equities, how far down the Russell 2000 do you want to go? What's the maximum percentage of the stock's daily trading volume that you want to be? Because it's very easy to have a stock's price go up if you're the only one buying it. So you need to make sure that you are not the market, that there is a real market that you're reacting to. And so, but as you can do that by expanding the number of instruments, which is part of, I guess, Numerai Supreme as well.
Yeah, it is actually. In fact, it's on the horizon to increase the size of our universe a little bit, which might irritate some data scientists because you might have to, that could be in V5 data, but not sure when that's going to come. But yeah, like we've kept the capacity low, and I think there's always a choice. Like, do you want to be an asset gatherer and charge small fees on large assets, or do you want to go big and try to make very high returns? And there's a huge trade-off that's quite sharp. But I like that, maybe we can do both with like Numerai One for institutions, Numerai Supreme for individuals with high risk appetite.
Yeah, and that would be family offices and all those people who can no longer get into Medallion, some of those type, or Two Sigma, or some of the AQR funds when they were performing. But the key also to a Medallion-like return, and I think you're starting to get there with Numerai One, is consistency. So that you don't have on Numerai One, you may have it in Numerai Supreme. You don't have very frequent drawdowns. You have occasional ones, but not really frequent.
Yeah.
And that is what institutions really love. They love the notion that every month or every quarter at least, you're likely to be successful. And with Medallion, that's been true, although institutions are no longer in it, but it was sort of making money every single quarter. Now, I'm willing to tolerate more volatility than that. So, but as you say, when you drop 25%, that means that you have to be up 33% to get back to even.
Exactly. Yeah, it does seem. I was talking to Howard a bit about this product because he gives me good advice all the time whenever I ask. And there are other versions of Numerai Supreme that could be they could have 33% drawdowns, and that does start getting it's just bad for the business. And that's what I like about it. Like we couldn't have made Numerai Supreme our first fund because we would have potentially, any redemptions would have been catastrophic to the company. But now that we have, some institutional cash flows, we can start making these higher return products. So I think it's going to be really cool. I mean, part of the reason you get into this game isn't to make 4 or 5% return or something like that. You are not an institution. You want to try it with more money. So I'm excited to be one of our LPs in Numerai Supreme.
Yeah, I'm ready to sign the docs when they.
Okay, well. We will talk. Maybe you get a fee discount. Okay, well, yeah, thanks so much, Howard. I mean, and again, thanks for wearing a cape and a T-shirt.
Love it. Love it all. But I really love the fact that you built such a great community, of people over the last number of years, 5-6 years, and that you're giving them the opportunity to make money in the process while indulging their mathematical and data science activities, and that really grows the community of people who are experienced in these kind of things. And that's been a terrific thing that I don't think I anticipated as much when we started this, that we would build such a terrifically supportive community that supports each other.
Yeah.
In some of the ways I saw in some of the earlier talks today. Which is great.
Yeah, I love that too. I mean, they share ideas with each other. They talk to each other. They write forum posts, and it makes the whole environment so much more kind of collegial than you might have inside one of these firms where you have all sorts of other things to worry about, like NDAs and things like that. But yeah, it's been amazing to have all of them here today, and they are some of the best data scientists. And so I feel very confident staking my money behind your stakes.
Yep, I agree. Well, it's really great. Sorry I couldn't get out to San Francisco today, but I'm stuck here in chilly New York City. But it is great to be part of this journey and to continue, hopefully for many years to come.
Thank you so much. Thank you, Howard.